Hello everyone. In today's video, we'll be discussing about discounted cash flow investment appraisal techniques. Now, the difference between the basic ones and the discounted cash flow investment appraisal technique is that the discounted cash flow investment appraisal techniques considers the time value of money. Now, as you know that if you have money today, it's worth more than the same amount of money you will have it in future. Okay. So let's suppose if you have $1,000 right now, it can buy you more stuff than that same $1,000, let's say after 5 years. Now, the reasons for which the money today has a time value is because of its potential for earning interest. Let's say if I keep that $1,000 in a bank, I'm with the government, for example, at least I'm going to get a certain amount of return from that. That's the first reason that why money has a time value, because it has the potential to earn interest without any risk. I mean, you can guaranteed a 2% or 3% return on that from the government itself, right? Second reason of why money does has a time value is because of the inflation. Prices of the goods get expensive over the period of time, so that $1,000 can, let's say, buy you an X liters of petrol today, but for that same $1,000, because of the inflation, after 3 years, that $1,000 will not be able to buy you that X liters of petrol. The petrol will get expensive over the period of time, and that $1,000 will not be enough to purchase the X liters of petrol what you have done, let's say 3 years before. Lastly, why money does has a time value is because of the risk. So if the money will come after a certain number of years, it's more riskier that you might not get that money. But if you have the money today, it's less risk. So the more period of time it will take for you to money come back, the more riskier it will be, and hence money in today's term will have a time value. Okay, so moving further, now we need to understand the concept of interest. Now, interest can either be simple or compound. Okay, so when you talk about simple interest, it's actually that you're getting a fixed amount of interest on your principal amount every year. The amount of interest what you get is constant, fixed every year. But when you talk about compound, the interest what you're earning on the principal will also further earn interest for you. Okay, so in when we say that the interest has been compounded, it means that your interest will also earn interest for you if you don't withdraw the money from the account. So whatever interest you have earned, that will also be treated as your principal, and it will also make up interest for you. But in cases when it's simple interest, the principal is fixed, and the amount of the interest what you get every year will also be fixed. Now, with some calculations, we can understand the concept of simple interest and compound interest, and then I'm going to explain you that how this concept is linked with your discounted cash flow investment appraisal techniques. Now, let's say you deposit $1,000 in a saving account which pays 10% simple interest every year. Okay, so what would be the value of your investment after 5 years? Now, simple with if it's simple interest, you will get a fixed amount of interest every year. So on that $1,000, what you have invested as your principal, you will get 10%, which is $100, and for 5 years you will get 500. So by the end of the fifth year, the value of your investment will be 1,500. 1,000 was your principal, and $100 you have earned as an interest every year for 5 years. So that makes up another 500. So the total value of your investment after 5 years would in that case be 1,500. Now, the formula for calculating the simple interest would be, we call it as future value or your terminal value. P stands for the principal plus, this is in the bracket, you take N, that represents for the number of years, which was 5. R stands for the rate of interest, which is 10%. I'm going to write it down as 0.1. and P again stands back for your principal amount. So if you see over here, 5 was the number of years, point 1 is the rate of interest, 10% as point 1, and $1,000 was your principal amount. So 1,000 multiplied by 5, you get 5,000, into 10% you get 500, plus 1,000 the principal amount. So the future value in this case will be 1,500. But now if you move to the compound interest, let's see over here. You have deposit $1,000 in a saving account, but in this saving account, the interest is being paid in a compounded fashion, in a compounded way. What will be the value of your investment after 3 years? So it will not be 1,300 in this case. I'll explain you with the formula. Now see, after 1 year, your $1,000 will become 1,100 actually, because you earn 10% interest on that. Okay. But after second year, it will not be 1,200. This total 1,100 will be earning interest at the rate of 10%. So it's not only that 1,000 which is earning interest for you, the 100 of interest which you earned in the first year will also be earning interest for you in the second and in the third year too. So in this case, 1,100 multiplied by 1.1, you get 1,210. So now you got $10 extra because your interest, what you have earned in the first year, is also earning interest for you. Likewise, after 3 years, now I'm going to be earning on that 1,210 basically, right? So 1,210 into 1.1. So the value of the investment will become 1,331. So if you see over here that $31 is extra over here, which is because whatever interest you were earning, it has also helped you to earn further more interest. So that's the principle of compounding, that your interest will also earn interest for you, including your principal amount. But when, as we saw previously, that when you are talking about simple interest, your principal amount was only earning interest every year in a constant way. Okay, so we can put this thing in a formula, which is future value is equal to present value multiplied by 1 plus r to the power n. So first you need to solve the bracket, excuse me. So first 1 plus r to the power n. R is again your rate of interest and n stands for number of years. Okay, so here's the solution. 1 plus the rate of interest, which was 0.1. So 1.1 to the power 3, that will give you 1.331. And if you multiply it with the principal value, what you're investing today, that's 1,000, you will get the future value, which is 1,331. It's very important for you guys to remember these formulas in the exam. Although they will be given it to you in the exam, but still, just to know the formula and how it works, it's quite essential for you to do the calculations. Now, from compounding, there is a concept of discounting. Okay, so you need to understand that what's the difference between compounding and discounting. Now, compounding was to go from the present to the future. Okay, in present, if you have $1,000 and you want to find out that what will be the value of my investment after 3 years or 5 years, we call it as compounding. So you are going from the present value to the future value. Okay, today's $1,000, after 3 years it will become 1,331 if the interest rate is at 10%. But discounting is quite opposite of it. Discounting is from future to present. Okay, that $1,331 which you will have after 3 years, if the interest rate is at 10%, in today's term, it's only 1,000. So what you can buy today with $1,000 for the same amount of stuff, you have to pay 1,331 after 3 years, if we assume that the interest rate has been constant at 10% for the entire 3 years. Now, how we can find out the discounting formula? Okay, so this was the formula for compounding, in which we were talking about going from the present to the future, right? So it was P multiplied by 1 plus r to the power n. Now, let's suppose if I say that the future value is 6, for instance, principal is 2, and the answer of this part, which is in the bracket 1 plus r to the power n is 3. Okay. So I don't think that there would be any problem if I shift this 1 plus r to the power n on the other side of the equation, right? So I'm shifting 3 on the other side, and it will give me the present value, or which we were talking about, principal amount. So in compounding formula, the language what you're going to use is principal amount, but when you're talking about discounting formula, you will be using it as the present value, today's value. Okay. And this thing we can also write it like in this way. Okay, so there's no harm of writing 6 by 3 into 6 multiplied by 1 over 3. It will give you exactly the same answer. But why am I doing it like this way? Like you see, I have done multiply by 1 divided by 1 plus r to the power n, because collectively we call it as your discounting factor. Okay, so if you apply the future value and multiplied with the discounting factor, you will get the present value directly. Okay, so you don't need to use the formula, because this the discounting factors are given to you in your exam and in the present value discount factor tables also. So if you can use the table and find out the relevant factor, you just multiply it with the future value and you will get your present value. However, the problem with the table is that if the interest rate is not a whole number, like if it's 5.5 or the year is 3.5 years, then in that case, the table will not be able to work for you. So in that case, you have to use the formula. However, in the exam, it's less likely that you will be getting questions where the rate of interest is not a whole number and the number of years are also like mid-year, half year, or quarter of an year. So in that case, the table works perfectly well for you. However, for increasing the speed of solving the questions in the exam, it's better that you are familiar with the formula. Okay, so future value multiplied by the discount factor. This whole thing which I have bold, we consider it to be as discount factor. So if you multiply the discount factor and the future value, you will get your present value. So let's try a question over here. What is the present value of 115,000 receivable in 9 years' time if the rate of interest is at 6%? So the rate of interest is at 6%, and I want to find out uh, the present value of this 115,000, which I'm going to be getting 9 years. Okay. And the interest rate is at 6%. So I need to find out that what will be the value of it in today's term. So I'm trying to go from the future value to the present value. In future, I'm going to get 115K, but in today's term, what's exactly the value of that 115K? So you can put the formula, which is this one, the discount factor, 1 divided by 1 plus r, that's the rate of interest, 6% to the power 9. So you have to first solve this thing in the calculator. Okay, and then you will get 0.592 for that. You have to round off to 3 decimal places, and you can also use the table. And if you see at 6% and for 9th year, you will get 0.592. So if you multiply your future value, which is 115,000, 115K, by 0.592, you will get the present value, which is 68,080. So what today I can buy with 68,000 approximately, the same amount of goods after 9 years. If the interest rate is at 6%, for that very same thing, I have to be paying 115,000 actually. Okay, so in today's term, it's not 115. The money has lost its value. In today's term, it's only going to be 68,080. Okay, now the interest rate what you will get in the exam can be of different names. Either you can call it as cost of capital, you can call it as discount rate, or you can even call it as required return. So you don't have to worry about that. What is the interest rate called in the exam? It can be called as cost of capital, it can be called as discount rate, or it can be called as required return. You don't have to worry about the terminology. it serves exactly the same purpose. It's at the end of the day, it's the interest rate. Now, bringing the principle of discounting, we're going to be understanding the first of discounted cash flow investment appraisal techniques, which is the net present value. Okay. Now, a project will give you cash flows in future, right? For 5 years or 3 years or 10 years or whatever the life of the project is. All that future values, you have to bring it in today's terms, in today's value, in present value, right? And once you have subtracted the cost of investment, which you're doing right now, you will get something called as the net present value. If the net present value is positive, I mean, in that case, you say that the project is financially viable. If the net present value is negative, you say that the project is not financially viable. In case if the net present value is zero, you say that the project has break even. So what I'm going to be doing is that I will be discounting all the relevant cash flows associated with the project back to its present value. Okay, because the project will be, let's say, for 5 years, and in all that 5 years, year 1, 2, 3, 4, 5, you will be earning cash flows from that project, but that's in future. So it might sound to you good that I'm going to be earning 300,000 in at the end of the 5th year, but you need to see that 300,000 in today's term, how much worth it is basically. And that's why we consider these net present value or internal rate of return or discounted payback period as superior investment appraisal techniques, because they do consider the fact that money has time value because of its potential to earn interest, because of the risk element, and because of inflation too. Okay, so whatever your outflows are, you're going to be treating it as a negative in a bracket, and inflows will be considered to be as a positive. You net them off and you get the net present value. And as I explained you, that if the net present value is positive, the project is financially viable. It will be asked in your exam that comment on the financial viability of the project, and in one line you can just simply say that based on my calculation, the net present value is positive by, let's say, 1 million, and hence the project is financially viable. Irrespective of your correct or wrong calculation, you still do get a mark on the comments, because your comments are judged by the marker based on your calculated answers. Okay. If the NPV is negative, the project will not be considered to be as financially viable. If the NPV is zero, then the project is considered to be at break even. However, in the exam question, if you have given two different mutually exclusive projects, obviously you will choose the project which is giving you a higher NPV. Okay. Now, while you're calculating the net present value, you have to make up certain assumptions over there, that all cash flows occur at the start or at the end of the year. As I explained you that practically it's not like that way, that you will be getting all the cash inflows or outflows on 31st December or on 1st of January, for instance. It happens during the year. But just for the sake of convenience in the exam calculation, we assume that either they are at the start of the year or at the end of the year. Hence, you can take whole numbers while you are calculating the discount factor. Okay. Second assumption, that initial investment will occur right now, today. Okay. So you don't have to discount that. But normally, practically, the initial investment might take 1 year to be spent out, but or maybe more than 1 year. But for the sake of convenience in the exam calculation, we just simply assume that the initial investment, what we are doing, is right now. And all your cash inflows and outflows will start 1 year after that. So you don't have to discount based on 0.5 year and 0.75 of the year. No, you can just start discounting it from exactly year one. Okay, so now we do have a question over here, and with the help of this question, I'm going to explain you the principles of net present value. Okay, so you see that today, year zero, right now, I'm going to be spending 25,000 for this project, and the life of this project is 4 years over here. and I'm going to be getting 6,000 in the first year, 10,000 in the second year, 8,000 third year, fourth year, 7,000. So if you just count them simply, it's 10 plus 6, 16, 8, you get 24, and 7, you get 31. So technically, you think that you're making a 6,000 return because $25,000 you have spent, and over the period of 4 years, you are getting 31. So that gives you a net answer of 6,000. But that's not exactly how it's supposed to be done. Because you see that the interest rate here, the name in the question for the interest rate, what I've used is cost of capital, and the cost of capital is at 6%. So what I'm going to be doing is that you see that I have used a discount factor because these all values are my future value. After 1 year, I'm going to get 6,000, but that 6,000 in today's term is only 5,658. So what I can buy today with 5,658, the same thing, after 1 year, I have to be spending 6,000. So while I'm doing an investment appraisal, I'm not considering that 6,000 actually. What I'm considering it is today's value, which is 5,658. And the question is, how did you got the discount factor? It's simply 1 divided by 1 plus r to the power the number of years. So 1 divided by 1 plus r, that's 6%. So it's going to be 1 divided by 1.06. And that 1.06 is to the power of 1 because we are talking about the first year. Likewise, you have to do for the second year, third year, and the fourth year. You see that $1 over the period of time has lost its value. Okay. So this is the discount factor. So you can either use it from the table, or if you wish, you can also simply calculate it. So 6,000, which I'm receiving after 1 year, in today's term, it's 5,658. 10,000, what I'm receiving after 2 years, in today's term, it's only 8,900. Third year, after 3 years, I'm going to be receiving 8,000, which in today's term is only 6,720. 7,000, which I'm receiving after 4 years, in today's term, it's only 5,544. So all these are positive. This one is negative. I net them off and I get an answer of 1,822. Because my answer is in positive, you can see a statement over here. The project is financially viable as the net present value is positive by 1,822. So that 6,000, what you were assuming, is not exactly 6,000. Okay. In today's term, it's only 1,822. What you can buy in today's term with 1,822, that is what you will be buying it with 6,000 over the next 4 years, actually. So if the NPV is positive, we are going to say that the project is financially viable because it increased the wealth of the shareholders by 1,822. If it would have been a negative over here, then I would have simply decided to reject the project. Okay. So now moving further, let's have a discussion on the pros and cons of net present value. Okay. So let's see the positive side of the net present value as an investment appraisal technique, that it considers the time value of money. It's an absolute measure of return, like a complete measure of return. In the previous question, we said that 1,822 is the return of that project. That's what I actually mean, that it's an absolute measure of return. It is based on cash flows and not on profits. Fine. We have already understood that, except the return on capital employed, which is based on uh, which is based on profits, exactly. The rest of the methods are all based on cash flows. It considers the whole life of the project. Now, I am actually looking at what are the returns which I will be earning in the entire 4 years of the project life. Not like in payback, where I was only worried about the period in which I'm going to get my initial capital investment back again. I didn't consider the whole life of the project, only that part of the life of the project where I was supposed to get my principal amount back, the investment amount. And it should lead to maximization of shareholder wealth. Now, later on, you will understand that the companies have limited funds. Okay. So when they have limited funds, they try to utilize their funds where they can get the maximum return for their investors. As I explained you that if you are given with two different projects, like you have to choose with one, any of them, obviously you will choose with a project which is giving you a higher net present value. So hence, the wealth of the shareholder will be maximized with the help of net present value investment appraisal technique. However, the negative side of the net present value is that it's quite technical. So if your financial manager has not a sound background, like your managers and directors, if for example, if they don't have a sound finance background, it would be very hard to make them understand. It requires the knowledge of the cost of capital, which is a separate chapter, which is a separate science, because right now in these questions it's quite easy to give you that okay, the cost of capital was 6 or 10 or 11 or whatever, but reality is far quite different from that, and it's relatively complex. So this method is not simple as you were dealing with payback or ROCE. It's quite complicated. You have to make a lot of estimates, you have to make a lot of assumptions, you have to make a lot of calculations, and which ultimately increases the complexity of this method as an investment appraisal technique. Now, the cash flows can be in terms of annuities. Okay. Now, when you say annuity, it's basically you're getting or you're paying a fixed amount of money for several years. Like, for example, if you have a lease on your car, so let's say you might be paying $5,000 every 1 month, for instance. So that becomes an annuity that you have to pay $5,000 for, let's say, 5 years. So the amount of payment, what you're doing, is fixed for a number of years, and that's why we consider it to be as your annuity. Now here, let's try this. If you see the same question, the investment was $25,000 right now, and in all the 4 years of the life of the project it's earning 10,000. So this 10,000 is a constant amount for all the 4 years. Okay, so the life is limited, which is 4 years, and the amount is also constant at 10,000, and the rate of interest which is given to you in the question is at 10%, right? So if you want to find out the net present value of this, again, it's the same way. I have taken discount factor 0.909, 0.826, 0.751, and 0.683. That's for 10 percentage at their respective years, for year 1, year 2, year 3, and then year 4. And here you get a positive net present value of 6690. And you can see that I've written that project is financially viable as the net present value is positive by 6690. Now, here you do understand that the cash flows were in annuity because it's for a fixed number of years, which is 4, and the amount is also fixed. So instead of doing this long big calculation, what you can simply do is that you do have a shortcut over here. Okay, so I've written 1 to 4 because the amount is constant, so I don't need to write it 4 times. I can just simply write it once. And instead of taking all the factors individually, I can just simply add them up, and I'm going to get 3.170. Okay. So the present value turns out to be 31,700. So that 10,000, what you are earning every year for the next 4 years, in today's value, it's not 40K, it's going to be only 31,700. And you get your net present value over here of 6,700. The answer would have been same, but if you round the factors, discount factor, you might get some sort of difference, a very minimal difference, but that's fine. Anyways, the project is financially viable as the net present value is positive by 6,700. There, I guess it was 6690. So $10 difference, that it's fine. But this 3.170 can be calculated, and we call it as annuity factor. So you do guys have the annuity factor on your exam, on your tables. That's a separate table with the heading of annuity factor table, and you will be given there. So in case if in the question when the cash flows are in annuity, instead of for every cash flow you're applying a separate discount factor, what you can simply do is that you can apply the annuity factor, because annuity factor is the sum of the discount factors. Okay, so you have a formula over here to find out the annuity factor, which is 1 minus 1 plus r to the power, but this is minus n then. And once you have solved this bracket, then you simply divide by the rate of interest. You will get your annuity factor. So while you're doing the calculation on the exam, first you do 1 plus 0.1 to the power minus 4. First you solve this. Then from that answer you subtract, that is being subtracted from 1. And then you divide by the rate of interest, which is 0.1. You will get something like this. So it's 1 point minus 0.683. And once you solve this and you divide by 0.1, you will get 3.170. So you see that I have first solved the bracket, which is 1 plus 0.1 to the power minus 4. I'm going to be getting 0.683. So then from this one, I have to subtract 0.683. And then whatever the answer is, I'm going to divide it by 0.1. So I'm going to be getting my relevant annuity factor. Now, if you remember the formula is good for you, but if not, all these formulas are given to you in the table also. And the table is itself given. So you have the table to find out those factors directly, or you can just simply use the formula and try to find out the annuity factor too. Okay. Now the cash flows can be in a different way, which we call it as perpetuity. In perpetuity, it's for the foreseeable future. Like there is the number of years are not fixed. A lot of people get their pension, for example, in perpetuity for the foreseeable future. Okay, so the amounts can be constant and can grow also, but the point when you're talking about perpetuity is that it doesn't has a limited number of years. It's for the foreseeable future. So it's an annual cash flow that occurs for the foreseeable future. I mean, there is no limit to the number of years for which you will be getting your pension payment, or you will have to pay the insurance payment, or payments like of those nature. Okay. So for perpetuity factor, it can be without growth and it can be with growth. So if it's with growth, without growth, you can just simply say that the factor will be 1 divided by rate of interest, 1 divided by r, that stands for the rate of interest. But in case if you have the perpetuity with growth, a certain growth, then in that case you have to deduct the growth rate from the rate of interest. So it becomes 1 divided by r minus the g. R stands for the rate of interest and G stands for the growth rate. At what growth rate the amount of cash flow what you have to pay or receive will grow in future. Okay. So here you have a question. The first question is without growth, and the second one is with growth. So if you see over here, it says what will be the present value of 3,000 received in 1 year's time, and then for the foreseeable future at a discount rate of 10%. Now, I mean, you're going to be getting $3,000 for the entire life, for instance. Okay. Now, you might think that it's a huge amount, that because you're getting $3,000 for your entire life, and the interest rate is at 10%. But in today's value, it will only be like this. See, the perpetuity factor is 1 divided by the rate of interest, which was 0.1, right? So 1 divided by 0.1 gives you 10. Multiply by 3,000. So in today's value, it's 30,000. So let's say that if this promise has been done by bank to you, okay, the bank says that I'm going to be paying you $3,000 for your entire life. So basically what the bank has to simply do is that the bank will invest this $30,000, and every year they're going to get $3,000, which they're going to be giving you forever. So the cost of committing to you for the bank to give you $3,000 every year, in today's term, it's only $30,000. Okay. So you might think that in 20 years, you will be getting, let's say, 60,000, but no, that's only in terms of cash. Okay. In terms of value, it's only worth $30,000. That's it in today's term. So the bank will put $30,000 aside for you it will keep on earning interest at the rate of 10 percentage, okay, and 10 percentage interest, and that is the only amount they will give it to you, which is $3,000, right? Now, if you look up at the second question, it says that what will be the present value of 3,000 received in 1 year's time and then growing by 2 percentage every year for the foreseeable future. So next year you will get 3,000, but then every year it grows up by 2 percentage. So it looks a very big amount, but it's not exactly the case, because in terms of the present value, you see that I told you that the formula for perpetuity factor with growth will be 1 divided by the rate of interest, which is 10%, and the rate of growth is 2%, so that's 0.02. So if you solve this factor, you will get approximately, so it's 1 divided by zero point 0.1 minus 0.02. So this will turn out to be 12.5. Okay. 12.5 multiplied by 3,000, it will become 37,500. So the commitment what the bank or any company which is doing with you, that they will give you $3,000 the next year, and after that they will keep on growing it at 2% every year. So what they have to do for you is that they just simply have to set aside 37,500 for your perspective, and they will give you, because this 37,500 is going to be earning interest for the bank, and from that they are going to give you every year 3,000 and then start growing it by 2%. Now, so far we were assuming that those annuities and perpetuities were starting after 1 year, okay, but it might not be the case. Some annuities might be starting from right now, okay. I'm saying that I'm starting paying you this $3,000 from now, from today, so that becomes an advance annuity or perpetuity, right? So that is considered to be as advanced annuity and perpetuity when the cash flows don't start from next year, like after 1 year. Rather, they start from the current year. That's now, right now. Okay. And likewise, in further, we will also have delayed annuity and perpetuity, where the annuities and perpetuities don't start after 1 year. Rather, they might start after the fifth year or third year or sixth year, so they won't start after 1 year. So if the cash flows are starting from now, we call it as advanced annuity or an advanced perpetuity. Remember that annuity could be for several years, but perpetuity is for the foreseeable future. Delayed annuities and perpetuities will not start from now or the next year. Rather, it's going to be starting after year one. Okay. Now, how you're going to deal up with these advanced annuity and perpetuities is that instead of cash flow starting after 1 year in T1, cash flow starts from now, that's T0. You just simply add 1 to the normal annuity or perpetuity factor for the payment which you're receiving today. So I'll explain it to you with a question. See, a 5-year annuity of 500 starting from now, interest rates are 10%. So basically, you will get 5 annuity payments of $500 each. One you will get right now, second one after 1 year, and so forth. Okay. So now the question is that you need to find out the present value of annuity. The point is that the normal 4 annuities you will get after 1 year, right? So what you're going to simply be doing is that apart from the payment which you're receiving in advance, the remainder of the payments are 4. So you have to find out the annuity factor at 10% for 4 years, which is 3.170. We already calculated before. And in that 3.170, you will just simply add 1 because of the amount of money which you're receiving right now, because that won't lose the value. Okay. So that will turn out to be a relevant factor of 4.17. So that 500, what you are receiving from now for the next 5 years, okay, in that term, the present value of that annuity will become 28.5. So that's $2,085. So if somebody says you that I'm giving you 500 right now, and I will be giving you 500 for the next 4 years also. So basically, the present value of that $2,500 in today's term is only 2085. Okay, so what you can buy today with that 2085, I mean, you can buy the same stuff over the next 5 years. Likewise, now we have a question for perpetuity. Okay, so it's a perpetuity of 2000 due to be commenced immediately. So you will be getting $2,000 for your entire life, but it will start from now, not after 1 year. Okay, interest rates are again 10 percentage, and you have to find out the present value of that perpetuity. So the normal perpetuity factor was 1 divided by the rate of interest, which is zero point 0.1. So the normal perpetuity factor turns out to be 10. If that would have been the case, if the payment, whatever you're receiving of $2,000, wouldn't have been from now, if it would have been from after 1 year. But now, because it starts from in now, you just have to add 1 into the normal perpetuity factor, and hence the relevant perpetuity factor will be 11. You multiply it with the future value, which is 2000, and you will get the perpetuity's present value, which is going to be $22,000. So instead of 20,000, now it's 22 because of that $2,000 which you're receiving right now. Now we have delayed annuity and perpetuity. So when we are talking about delayed annuity and perpetuity, it actually means that the cash flows might start after T1. Excuse me. So it's not starting after 1 year, but rather after more than 1 year. Okay. So in this case, you forget about that the payments are being delayed. You just calculate the normal factor which you were supposed to apply, and but then you have to discount it back to today's term. So I'll explain it to you with the help of a question. Now, see, we have three cases over here. The first one is find the present value of the following cash flows, assuming that the cost of capital is 10%, a 7-year annuity of 450 starting in 4 years' time. So you will get $450 for the 7 years, but not after 1 year, in 4 years' time. Okay. So basically, from the fourth year onwards, for the next 7 years, so that makes up a total of 11 years, you will be getting 450. So in this case, what I will be doing is that I will ignore that the payment has been delayed for 4 years. Like I'm getting the payment in the fourth year, right? I'm just going to simply find out the 7-year annuity factor at 10 percentage. Okay, so with the help of formula or with the help of the calculation, you can just simply find out 7 years annuity factor at the 10 percentage, which will be 4.868. However, you need to understand that the payment has been delayed by 3 years. Instead of getting it in T1, you're getting it in T4. So that makes a difference of 3 years. Please make sure that it's not 4 years, it's 3 years. Because normally we were assuming that you will get the payment in T1, but now you're getting the payment in T4. So from 1 to 2, that's 1 year. 2 to 3, that's the second year, and 3 to 4, that's the third year. So the payment has been delayed by 3 years. So what I'm going to do is that I'm going to find out the discount factor at 10 percentage for 3 years, which is 0.751. Normally, the factor would have been 4.868, but because the payment has been delayed by 3 years, I need to multiply them 4.868 into 0.751 to get the relevant factor. Okay, so this is, I'm discounting the normal annuity factor of 7 years at 10 percentage. Normally, it would have been 4.868, but because there has been a delay of 3 years, that will lose the value and it will become at 0.751. So this gives me a relevant factor of 3.656, and hence the present value of the annuity would be 1645, because 450 is what I'm getting for the 7 years. And if I multiply it with the relevant factor, which is 3.656, I'm going to be getting my annuity's present value at 1645. Okay, so now if we go back on the second example, it says a perpetuity of 14,000 starting in 10 years time. So I will be getting 14,000 forever, but in 10th year. Okay, so here the annuity is the perpetuity is forever. So I'm going to be using my normal perpetuity factor formula, which is 1 by r, but I need to understand that there has been a delay of 9 years. Okay, so here we go for the second case. Normal perpetuity factor would have been 10. That's 1 divided by the rate of interest of 0.1. So you get 10. However, there has been a 9 years delay because normally you were getting the payment in T1, but now you're getting it in T10. So that has been a delay of 9 years. Okay. So the discount factor at 10% for 9 years is 4.24. So hence, if you want to get the relevant discount factor, the perpetuity factor, it will become 10 multiplied by 0.424. So that gives you a relevant factor, perpetuity factor of 4.24. You were getting 14,000. So 14,000 multiplied by the future value is 14,000 and the relevant perpetuity factor is 4.24 and not 10 because there has been a delay of 9 years, and hence that 10 has lost its value. It's now only 4.24, and the present value of that 14,000 receipt, what you will be getting will be only 59,360. Okay. Likewise, for the next case where you're getting a perpetuity of 2,000 starting in 6 years time, so you can understand that there has been a delay of 5 years, but it will grow at 6% per annum. So simple, you have to apply the perpetuity factor with growth, which was 1 divided by the rate of interest minus the growth rate. So it's 0.1 minus 0.06, and then you take 1 divided by your answer, you will get 25. Okay, so it's 1 divided by 0.04 technically, so you get 25. Normally I would have been using the factor, perpetuity factor of 25, but because there has been a 5 years delay, so hence the discount factor at the rate of 10% for 5 years is 0.621. So I have to discount this 25 to back by multiplying it with 0.621. Hence the relevant perpetuity factor what I get is 15.525. And as I'm getting $2,000 every year, and then it will grow at 6%. So the present value of that cash flow will be 31,050 only. Okay. Now, moving to the next investment appraisal technique, discounted cash flow investment appraisal technique is the internal rate of return. Now, this is the discount rate or the cost of capital or the interest rate at which the project NPV is zero, or you can even say that it's a break-even cost of capital where neither your project is earning any return or it's losing money. Okay. So now the decision rule for internal rate of return is that if the rate of return is higher than the interest rate, then only you will accept the project. So the project should be accepted if the internal rate of return is greater than the company's cost of capital. So if the rate of return is lower than the cost of capital, you will simply reject the project. Okay. So for example, the rate of return of this project is 20%, but the cost of capital was 15%. I will be accepting this project because there's a 5% additional return from this project. Now, how to calculate the IRR depends on how the cash flows are given to you. Okay. So if there is a different cash flow every year, we say that you have to use the linear interpolation and estimation method, which has a formula. So what I'm going to be doing in this case is that I have to calculate two different net present values at different cost of capital. You can choose any of the cost of capital as of your wish, and then you're going to apply it in this formula. Okay, so I'll explain this formula to you very soon with the help of this question. So now let's see, this is the same question which we started with when we were understanding the principles of net present value. at 6%, you remember that the discount rate was 1822. By my choice, I have chosen 15%. You can choose 10, 12, 13, 16, 20, whatever. And you find out the net present value over here, which is 2952. Okay. So at 6%, the project is financially viable. The net present value is 1822. But if the cost of capital is at 15%, then this project doesn't make any sense to me because the net present value is negative. So I do understand that the rate of return at which the net present value is zero will be somewhere between 6 and 15. Okay, it's going to be between 6 and 15 because at 6 is positive, but as you keep on going higher cost of capital, the net present value keeps on going down. So there will be a point between 6 and 10 where the net present value is zero, and that's the internal rate of return, and that's what I'm trying to find out. So in the first step, you find out the net present value of the project at two different cost of capitals or discount rate or interest rate. And once when you have your this data, you can start to apply the formula. Okay. Now, this formula is basically this 6% is the rate of interest or the cost of capital where the project NPV is higher, right? So as you know that at 6% it was 1822, but then at 15% it was 2952 negative, right? So at the percentage, the cost of capital when the net present value is higher, that's 6. Okay, and here I have to take the NPV in this entire bracket. So 1822 is the net present value at 6% divided by, same again, it's the net present value at the cost of capital which is low, okay, where your NPV is higher. Now, this 2952 was the net present value when you took a higher cost of capital and it was negative. Now, because there is a negative in the formula, okay, I'll show it to you. A negative and negative will become positive over here. So if you see the formula over here, L stands for the lower cost of capital. NL stands for the net present value at the lower cost of capital divided by, again, NL, which is the net present value at the lower cost of capital, minus the net present value at the higher cost of capital, which was 15 in our example. Now, because the net present value is negative and there's a negative in the formula, it becomes a positive, okay? And then you can multiply by the difference of the higher and the lower cost of capitals. So now putting it back again to the equation. So it's 1822 plus 2952 minus minus becomes positive. Multiply by the higher rate was 15 and the lower rate was 6%. So now first I need to solve this, which is 1822 plus 2952. I get 4774, and the difference of 15 minus 6% is 9%. So after this, if you take 1822 multiply by 4 divided by 4774, and then you multiply by 9%, you will get 3.43, and you add 6%, so you will get your internal rate of return at 9.43. So basically, if you you can practice this, that if you take a discount rate of 9.43 or 9%, for instance, or 9.5, the project NPV will be at 0. Okay. Now, if the cash flows are constant every year, so we say use the table. I'll explain it to you how. So it means that in this case, the cash flows are in annuity. So you have to follow these steps. Find the annuity factor by initial investment divided by annual cash inflows. Okay. Now, what I'm going to do is that with the help of question, I'm going to explain you. See, find the internal rate of a project with an initial investment of 1.5 million and 3 years of inflows of 700,000. So here I'm not getting the cash flow in a different way. I'm getting 700,000 fixed for the next 3 years, and it will be starting from year 1. So what I'm going to do is that the first step would be that you find the relevant annuity factor by you divide your initial investment by the annual cash inflow. Okay. So here. The annuity factor you will get will be 1.5 million divided by 0.7 million. So that will give me a relevant annuity factor of 2.143. And the life of the project, which is the second step that you need to determine the life of the project, is 3 years. So what I'm going to be doing is that I will be having a look at the annuity table. Now, I have given you an extract over here. You have to find in the third year an annuity factor of 2.143. So if you look up at the third year, you see that 2.143 is closest to this one, 19. So this becomes the project IRR, the internal rate of return. So first you have to find out the annuity factor, which you have to find out by dividing your initial investment by the annual cash flows. The initial investment was 1.5 million and your cash flows every year was 700,000 or zero point 0.7 million. So you get the relevant annuity factor of 2.143. That annuity factor you have to look up at the annuity table for the column in for 3 years. So here is your 3 years, okay? And we are going to be searching. I mean, you will start searching from 1% and so further. And if you see at 19 percentage here, I get 2.140. So that's the closest one. So I can say that the approximately internal rate of return for this project will be at 19%. Now, if the cash flows are in perpetuity, I mean, you're getting the cash flows forever, and then you have to find out the internal rate of return. So you have a simple formula, which actually it was a reverse of the previous formula, which I explained you. That when you are finding out the annuity factor, you are taking the initial investment divided by the annual cash inflow. But here, what you have to do is that you have to reverse the formula, which is annual inflow divided by initial investment. So let's put that into a question. It says find the internal rate of return of a project that costs $20,000 right now, and you have to and it will generate 1,600 for the foreseeable future. So 1,600 divided by 20,000. In this case, the internal rate of return for this project will be at 8%. Okay. So if at 8%, this project will not be making any returns, and the net present value and the NPV would be 0. Now let's have a look on the positive and the negative sides of the internal rate of return. Now, again, it considers the time value of money. It's in a percentage form, therefore it's easily understood by the managers. It also uses cash flows and not profits like your net present value. It also considers the whole life of the project, and it will increase the shareholder wealth if the projects what you're choosing are having a rate of return above the discount rate. So if the cost of funding is at 10% and the rate of return of the project is 15%, it will help to increase the wealth of the shareholder. However, the problem with this method is that it will not help you to maximize the wealth of the shareholder. So when you are given a multiple choice of projects, in that case, IRR will not be the one giving you a concrete decision that which project you have to choose. In that cases, NPV is always a superior method than the entire methods you have available. Okay, because when you have a number of projects given, and as the manager has to decide that which project will be good for the company, because they cannot do all the projects, they have limitation of funds. In that cases, NPV is quite a superior technique, and it's a much better off technique than even internal rate of return, because it will lead you to the maximization of the shareholder wealth, which is the target of the financial manager, to increase the wealth of the shareholder, to maximize it. Okay, so it's not a measure of absolute profitability. Like if I say that the net present value is 2 million, I exactly know that that's the profitability of this project. But here it's in a percentage form, so you don't understand the absolute profitability of the project. That how much by how much value this project is increasing the wealth of shareholder. Now, the formula which we chose was interpolation method, and it's just an estimate. So if you need spreadsheet software to calculate a more realistic internal rate of return for the project. It's fairly complicated to calculate because you need to again apply the principles of NPV, and you have to do it at two different levels, and then you need to come up with the internal rate of return. But that's also with the help of formulas, just like an estimation. It's not the actual one. Non-conventional cash flows can give rise to multiple internal rate of returns. Now, if you normally we were assuming that there is an outflow and then followed by an inflow. So that's the conventional cash flows. But when the project has a non-conventional cash flow, it can give you multiple internal rate of returns. So we cannot rely on it. Interpolation method can only be used for conventional cash flows. It cannot be used for non-conventional cash flows when there is a outflow followed by an inflow only. And it assumes that the cash return from the project will be reinvested at the project's internal rate of return, okay, which is just the break even, but that's not necessary. The company can reinvest those funds at maybe at a higher rate also. So those are the problems with the internal rate of return. Now, as I already explained you that which one is better, NPV or IRR. So obviously NPV is better because it helps you to distinguish between two different projects and tells you that which one can lead to the maximization of shareholder wealth. And even it tells you the absolute increase, the amount by which the shareholder wealth has increased by accepting a certain project. Hence we say that net present value is a far superior technique in comparison to the internal rate of return. For further questions and inquiries, you can email it to me at rishfaisal@hotmail.com, or you can even WhatsApp me on the number shown on the screen. Thank you very much for listening.